Hi, I'm Tom Stelzer and welcome to Livewire's Alternative Series for 2025. Today I'm joined by Rachael Lockyer from MLC Asset Management to get her insights on the private equity markets right now. Rachael, thanks for joining us.
Thanks, Tom. Great to be here.
Rachael, if we could just start, I think private equities outperformed many other asset classes over the last couple of decades. What do you think the reasons are for this, and can you see it continuing into the future?
Yeah, it absolutely has outperformed. And when you look at the investments that we're making in private equity, you can see it's really that first institutional capital that's going into what was formerly a founder-run business. It really transforms it and takes it to the next level. A lot of businesses owned by baby boomers who are looking at succession options. We all know about the intergenerational wealth transfer, and that is enabling there to be a significant amount of private equity opportunities. So essentially private equity in the mid-market, where we're playing at MLC's private equity program, we're buying businesses off founders who are looking for a succession plan, or they're looking for a partner who can really take their business to the next level with additional capital and expertise. These businesses are small, but they're relevant and they're growing very fast, and they're not on the public markets because they're not big enough to be on the public markets, or for some reason they remain private. But fundamentally, there are about 10 times more businesses in the private markets than there are in the public markets. There's a huge market for private equity. And when we see that first institutional capital go into the business, they've got years of track record behind them and they know exactly the levers that need to be pulled. Typically when a private equity fund invests in a business, they have done months of due diligence, spent millions of dollars on, top consultants, really, unpicking this business, what drives it, and what are the value creators that we really need to lean into over the short period that we own this business for, say, 3 to 5 years, maybe longer. So by the time they get the keys to the business, the clock starts ticking, they are ready to go, and this 100-day plan is put in place for the management team and the private equity firm to really make sure the underpinnings of that business are ready to go, and that's through upgrading systems, making sure all the management teams aligned, removing any operational blockers, and really ensuring that everybody is aligned for significant growth in the future and putting together that plan on how that growth is going to eventuate. So I think it doesn't matter which time you're investing in private equity, there will always be that opportunity to buy a business of founders or people looking for succession, or a partner who can really fast track their growth through expertise and track record like we do.
You've covered off the opportunity set there, but what would you say are some of the key tailwinds for private equity right now, and how is that informing your strategy?
Yeah, there's a lot of capital going into the private equity market, which is fantastic. People are understanding that fundamentally the opportunity is there to capture the value creation through private equity ownership. And the public markets are strongly valued at the moment, you might say. Private markets are at a discount in terms of valuation to public markets, which shows the differential and I guess the opportunity in this vintage year in investing in private equity. And as an allocation, private equity it's a nice smoother in portfolios because it doesn't have that daily volatility that public markets has, and it does outperform over time, particularly through the value of compounding in a long-term asset class. We think the private equity asset class is a very attractive one. The tailwinds are bringing a lot of capital into the large cap part of private equity. We focus on the mid cap, mid to lower cap part of private equity. And so there are more than enough opportunities for the part of the market that we're in right now.
And what would you say is the biggest opportunity in private markets compared to public markets that maybe no one's paying attention to at the moment?
Yeah, we really like the blend between infrastructure and private equity. We see there to be outsized returns being made when private equity managers invest in businesses that are small, lower mid-market private equity opportunities, but they have infrastructure style characteristics. And I'm talking about, long-term, sustainable, recurring revenue and cash flows that are secured. So they might have some very long-term customers that are continuing to give them business, but there is very little downside. So they're embedded within the customer's framework. They might have some regulatory tailwinds and significant sort of commercial opportunities where you can scale these businesses. So for example, we're an investor in one of the largest bus companies in New Zealand. And really, we were alongside the manager in the electrification of that bus network. When that business went to get sold, it had turned from a private equity investment to an infrastructure investment. And the cost of capital for infrastructure funds is a lot lower than private equity. And so if you're setting up a private equity business to sell to an infrastructure fund, and you're doing it successfully, you can have a nice arbitrage in terms of your exit multiple.
And what value do you think private equity managers can bring to a business? And what would you say is the impact then for investors?
Yeah, look, we invest alongside specialist managers who really know what good looks like when it walks through the door or when they find it. So one example would be a private equity manager we work with in the US called Banksc. They are consumer specialists. We knew them for 15 years before they started their first private equity fund. The people who started Banksc came out of consumer private equity as well as running for 40 years some of the largest large cap consumer products businesses in the US. This is a US manager. So very deep consumer staples expertise. And the sectors in which they're looking at are consumer staples, and they know how to really dial up the growth on consumer staples. And so an example, we co-invested alongside them in a business called Arcadia, which initially was just the number one anti-dandruff shampoo in the US. Hopefully you haven't had to use it. It is now very much global. The opportunity there was to really create a conglomerate, a group of really highly effective, over-the-counter, healthcare but consumer brands that have completely, inelastic demand. So when you want it, you buy it. It doesn't matter what your income level is. Like if you need these products, you will buy them. And so Arcadia ended up being a group of about 8 really highly effective brands, including not just the anti-dandruff shampoo, but antifungal cream, stool softener, all the things that you would never want to use. But they've had the number one brand in the US for each of these. The betadine, that solution that you put on cuts if you need antibiotic qualities and sterilisation. They brought this group together, and so they utilised the marketing expertise that they had across all of those brands, selling into the same customers. And so the synergistic, benefits of combining multiple consumer products across a group have resulted in a very successful investment. It's one of the largest investments in the global private equity fund, still below 5% of NAV, but EBITDA has quadrupled since we invested in the company, and revenue's gone, tracked really well as well. So I think we've had a 19% CAGR growth rate, and so that business is an example of something that can barely be put together by specialist private equity managers. They're one of many that we work with. And I should add that Banksc, while we were their first supporter in their fund, they were an unknown quantity in the market. No one knew of them when we invested. They're one of 6,000 private equity firms in the US, but we knew them, and they're delivering top quartile results.
You've given a couple of examples there, but what type of business would you say you're normally targeting? What are you looking for as a private equity investor?
Yeah, we're looking for businesses that have significant tailwinds in the markets in which they're operating. They need to have a lot of growth embedded in the company already, but potential growth through the private equity manager's expertise. So we're looking for the sweet spot of the private equity manager. We're investing alongside experts globally, but we know so much about the private equity managers that we know that which sectors they do really well in. And so when we see an investment that's, we would say, in their sweet spot, where they've already demonstrated a really strong track record on multiple investments historically, and the playbook seems very logical and repeatable, that's when we go heavy on the investment. Subject to, obviously, the management team needs to be super aligned, and the situation with founders selling out, are they still motivated if they're still running the business? There's a lot of nuances to an investment which can make or break it, and ultimately it's to do with the people, and people are the most important thing at the end of the day with business. So we spend a lot of time working out, are they aligned? Is this in the sweet spot of the manager? And then we run multiple downside scenarios. So we're very risk averse. We try not to lose money. The loss rate for our portfolio is significantly lower than the broader market. So when we see there to be, significant customer concentration risk or significant regulatory risk, any other risk, we're trying not to be, too negative, but you do have to think about these things in the context of what can be a very long-term investment. What could go wrong? COVID was hard to predict, but it was very interesting to see how the top managers that we have in our portfolio really pivoted their businesses through COVID. So you also have to be working with experts who really know how to, to change in dynamic times and deliver great outcomes. So that's, part of the skill of the job.
And diving a little bit deeper, I think MLC have written that most of the value creation occurs in the first 3 or so years of the private equity lifestyle. How does that inform your strategy?
We prefer primary investments to secondaries. We still invest in some secondaries, but fundamentally we love being aligned with the private equity managers early on in their fund life and working with managers that are really incentivised by performance fees and carry. And so primary investments in first-time managers are something that we really like. And we've seen over time that primary investments outperform secondaries because they're not reliant on, the financial leverage of, discount to create value. They're fundamentally just there at the early stage where value is created with that first institutional capital. When the founders are receiving funds to really assist them and the expertise that they've always wanted to grow their business. You want to be there at that time, not 3 years later when a lot of that value's already been created, which is when the secondary buyers typically come in.
And on that note, how would you say the competition is in the private equity markets at the moment, and what impact do you think that's having on valuations, especially say compared to the public markets?
Yeah, look, with more money into the private equity market, it's increasingly competitive. You've got to be working with the top managers, the top private equity funds in the world, and that's not the largest ones. They're mid-size to lower size. They're the ones who are on the ground hunting the opportunities. They're the first in to meet the founders and really convince them to sell their businesses. And so, while there is a lot of money in the private equity industry in terms of inflows, we're really well positioned because we're working with managers who we feel have an absolute sweet spot of success, being specialists in their field. So we've got specialist managers in consumer, software, general industrials, infrastructure/PE, that nice blenders that I talk to. So they know what good looks like when they see it, and then they're not afraid to pay a market multiple when they see significant opportunity, but they're not going to overpay.
I think there's also been a lot of talk around the exit strategy dilemma for private equity investors at the moment, but how are you guys navigating that?
Yeah, it's not so much a dilemma for us, Tom. We've had some fantastic exits, particularly recently. I think the exit market is really buoyant right now. One recent investment that we have just exited, we signed the deal to exit, is with Intelligence. It's a data provider for the alternatives industry, so proprietary insights for private equity, private credit, hedge funds, and other asset classes. We invested in that business about 2 years ago, and back then it was really much focused on hedge funds, and it was reliant. Hedge funds really liked the product because it had great insights on who are all the investors globally into hedge funds, and so they could adapt their fundraising outreach to what they're seeing on the platform. Fast forward to today, the business is now diversified across multiple asset classes, as I mentioned, not just hedge funds, but all the alternatives that you would want. And S&P Global saw a significant need to get into the alternatives data analytics and insights category. With Intelligence was providing that. So we're excited to sell that business for $1.8 billion last week. It's about 2.2% of the global private equity fund NAV, so we'll have a nice uplift there. And some other exits that have recently happened more closer to home in Australia. You might be familiar with Quad Lock if you're a cyclist or a boatie, and you want to mount your smartphone onto one of those. Quad Lock is one of the leaders in its field. Recently sold that business to a strategic buyer, working alongside Quadrant. There have been a number of exits that are planned at the moment that are close to completion and exiting into continuation vehicles. There's a lot of opportunity there for us. So we're not seeing the exit dilemma too much at this point. Bearing in mind our portfolio is really nicely diversified across vintage years, so average age is around 5.5 years.
And moving on to the opportunity for investors, what do you think private equity is offering to investors that they might not be able to get from other asset classes at the moment?
Yeah, it's the alpha that can be generated in the private eye by fundamentally working with businesses that may be undermanaged in prior ownership. They may be part of a larger corporate and an unloved division that, if it carved out and given a highly incentivized management team, could really become a completely different business and grow much faster than it has done. We've seen plenty of opportunities in corporate carve-outs, small to medium-sized businesses that have succession issues, or they've got one of the founders just wanting to take some money off the table and bring in a new partner to really fast-track growth. It's hard to get access to the smaller businesses if you're on the public markets. If you are one of those smaller businesses, you tend to want to be in the private eye as opposed to the public eye because the compliance costs of listing can be quite cumbersome for smaller companies. There's just a lot of opportunity to create growth in these smaller businesses, and then perhaps list them one day or sell them to a strategic buyer or a large corporate who really values the customer or the product of that particular company. So the private equity businesses we're investing in, when we invest, we know who we're going to be selling them to. Like we're working alongside the private equity manager to really, make this business perfect for the next buyer and just get it ready for sale. And it's a fun journey and it's generated some great returns for our investors.
And finally, how should private equity fit into an investor's portfolio these days?
Private equity is an exciting asset class and one that a lot of people are thinking about allocating to. It's a long-term asset class. Ultimately, you want to be working with a private equity manager who has a long track record and who is a great fiduciary of your capital because it is a long-term investment. So investing alongside a firm that can really demonstrate that in terms of governance and track record is important. The asset class has a really nice smoothing effect portfolios because it doesn't have the daily fluctuations of public markets, and ultimately it's delivering better returns than any other asset class historically over time compounded. So we think it's a very attractive asset class to be in. We think the fundamentals are still there. If you look at the difference right now between public market and private market valuations, it's hard to ignore the opportunity in private equity right now, with valuations 44% below public markets.
Rachael, thanks for joining us.
Thanks, Tom. It's been a pleasure.
Thanks for tuning in. For more from our alternative series, make sure to check out the Livewire website and YouTube channel.